Let's see. All right, let me share the screen. Let me just bring up the slides. All right, you should be able to see my slides. All right, so market update, 2022 projections. And now this one is more heavily on equity trading, equity, stock picking and methodologies around that. But it's probably worth hearing it through, especially because stock picking and equity, buying equities is really just an all general purpose methodology that can help any person, any portfolio. You just want to just make sure you do it in a very specific way, or try to wrap your brain around the way I do it and see if you like it. All right, so here are the questions we're going to address. So how do the major index charts and sector ETFs look? What are they telling us? What's the price action of all these high flyers? Apple, Microsoft, Google, and well, I wouldn't call those high flyers. I mean, they're just doing great. These companies are doing great, but these were the high flyers: Peloton, DocuSign, Teladoc, Zoom, all through the pandemic. What are the breadth indicators telling us? What are the economic indicators telling us? How do corporate earnings look? What are the analysts projecting for 2022? How expensive is this market? How will the market trade now that the Fed is tapering quantitative easing and raising rates? Do we see a recession coming, especially from the Fed's hawkish actions? Should I sell some of my passive ETFs and funds that hold hundreds of positions? Should I add short exposure? Should I buy bond funds? What's better right now? Value, growth, smalls, mids, large, emerging, Europe, Asia, thematics? Which sector ETFs and stocks are best to rotate into now for sectors? Industrials, healthcare, financials, energy, staples, technology. What will be the best investment style for the first half of 2022? So for example, buying passive indexes or ETFs, or stock picking, buying breakouts, covered calls, dividends, non-directional trading strategies. What's the best methodology for stock and ETFs to stay invested in this expensive market, but able to protect gains and capital? So this one down here is going to be kind of the main last half of this presentation. All right, and then how well can an option selling strategy like Pinnacle do in this market now that the Fed is tightening? And those are all the questions. Okay, a little bit about me. So I'm chief. We have two firms. We have Upside Options, that's an investment publication, and then we have QTR Capital. That's a registered investment advisor firm. It's registered. So I'm chief investment officer for QTR. I'm chief publisher for Upside Options. I'm an adjunct professor at Chapman at the Argos School of Business, and I focus on statistics, econometrics, and analytics. And we were just talking about that, where most of the classes are back face to face, but some of the schools are back online. So I don't know, it's kind of all over the place. Because I also teach at Palomar and at University of Redlands when they need me. I'm just an adjunct. I'm a part-timer. I was in high tech for 20 years. My first job was in New Jersey, GE Aerospace Division, right by Princeton. I was in marketing, sales, VP of sales, co-founder of a bunch of different companies. Cadence was the largest one I was with. Cadence Design Systems, that's chip design software, and then a bunch of small ones. I was in Japan for a couple of years running the branch office for one of those companies. My education is in physics, electrical engineering, Columbia, and an MBA from Chicago Booth. Okay, overview of our actively managed strategies: large cap, small and mid cap, sector rotation. Sector rotation is we're buying the strongest stocks in the strongest industry sectors, and it's all cap. Just has to be greater than 250 million in market cap. Contrarian opportunity one. This one started off right after COVID crashed the markets. And I saw lots of opportunities to get into the depressed restaurant, retail, department stores, clothing manufacturers, hotel, casino, travel, leisure. I was estimating a 50% gain in about 15 months, and we almost hit that. We're at 40%. And now we're starting to just move the strategy over to a standard contrarian opportunity. Initially, it was called just opportunity one, but since now most of these have already give us the gains we wanted, but some are still in play of these beat up COVID plays, then I just put the wording contrarian in front of it. So meaning anything that's been beat up for a long time, usually 1 to 2 years, and then it's starting to bottom out, and then earnings are starting to grow again. Global sector rotation ETF. This one can handle like larger dollar amounts for someone that it's a little less aggressive. We draw from 90 industry sectors, and it's purely in ETFs, and we're constantly rotating into the sectors that are working. And also around the world, like Vietnam is on my list and it's looking good, and I'm going to be adding it soon. And Mexico is probably going to be added in the next day or two. Iron Counter Pinnacle, non-directional income generating options strategy, typically generates 3 to 5% monthly. And then Dividend Income Plus. This one's kind of a unique one. We buy a concentrated basket of blue chip dividend paying stocks, like 5 stocks, like AT&T, Verizon, Dow Chemical, Chevron, for example. Lever up the positions by 4 times. Then we open up 2 threshold hedges to protect against most downside risk. So it gives you an absolute targeted returns of 8, 9%, sometimes 10. What's nice about it is that it's 30% less drawdown during corrections or crashes. And that if the market stays down, your portfolio will typically recover 90 to 100% as the hedges mature. So it's pretty nice. All right, so these are the strategies, final results for 2021. Large cap 27, small and mid cap 28%, sector rotation 23%, global tactical rotation ETF 16%, contrarians 40%, Pinnacle minus 35. We got slammed. This is a non-directional trading strategy, and this market went straight up like 1999. I've been pushing up calls for a year. Just kept on hitting the calls over and over and over and over again. The market just went straight up. We had $4.5 trillion of COVID fiscal stimulus pushed into the economy, so the economy got overstimulated. Now the Fed's going to have a heck of a time trying to unwind this. Now we got all this inflation, and it's going to be tough, I think, for them to unwind this. Dividend Income Plus 8.5%. Okay, let's dig into the market. Earnings. Earnings is what we care about first. Earnings ultimately drive stocks. And this comes from FactSet. This blue is the S&P 500 index. So it's using this y-axis over here. And look at this uptrend. Straight up. This 1999, like 1998, 1999. And then we know what happened in 1999. That was the dot-com crash that started in mid 2000. We ended up in a 2.5-year recession, and it took 7 years for the market to recover. Am I saying that's going to happen here? Well, not yet. Not in 2022. But this is earnings growth right here. So this is forward 4-quarter earnings growth. So you take all S&P 500 companies, all 500 companies, take each of them, throw off earnings. IBM throws off $3.50. You know, Google, well, Google's a bad example because that one throws off like $100 worth of earnings. Apple throws off $8 worth of earnings. You know, you add it all up, and we have $220 worth of earnings now sitting around 220. That's forward projected 4 quarters worth of earnings, all added up, $220. You can see that earnings went straight up because the market was just overstimulated. So it is what it is. All these checks started showing up. People went on Amazon, bought all kinds of stuff, and then we ended up with supply chain problems, disruptions, you know, because we had that high demand and then not a lot of supply. Just created a lot of dislocations in the market, but the stocks just went straight up. Okay, so earnings were hit hard from COVID. They came down to about $140 worth of earnings. Again, we're looking at forward 4-quarter projected earnings. And then S&P 500 companies grew earnings by 50%, up to $220 in like a year. Just crazy growth. Juiced by $4.5 trillion of COVID fiscal stimulus. Market has been expensive all year, trading at about 21.5 times earnings. That's expensive. Usually that's about 10% too high. Should be closer to 19.5 times earnings, but when you have such strong growth, investors just keep on piling in. So market is classified as expensive. It's been expensive all year, but now things are going to probably change. All right, earnings are projected to grow 8% in 2022. So if you had just one thing to look at, and you're wondering what's going to happen in 2022 with the economy, at least like for GDP, looks fine. Don't see any crashes, or most likely the stock market won't crash. Stock market is dislocated from the economy. It's a different animal. It's all supply and demand, greed and fear driving all of that. But in general, for the economy, earnings are growing 8%. That's good, and should grow GDP by 4%, 5%. It's going to be nice growth, decent growth. We're still kind of digging out of a hole from COVID, and don't see any recessions in 2022. However, this Fed is going to has a major challenge to get out of this inflation, and they know that they overstimulated. Everything was overstimulated. All right, here's the S&P 500 index, straight up. January. This is a daily chart. I'm showing the 13-day EMA, exponential moving average, in red, 50-day EMA in blue. In general, when you're blue, 50-day line is upward sloping, and if the stock is, or the index is above the 50-day line or holding, trying to find support at the 50-day line, that means the stock market is okay and healthy. Straight up, 200-day line. It's nice for stock picking. It's nice for stock strategies. Makes everyone feel smart. You could pretty much buy anything. I can put a chimpanzee in a room with a Bloomberg terminal, and a chimpanzee probably would have made 20% in 2021. Here's the weekly chart, S&P 500 index, straight up. So we had the crash, and then we spent about 4 months here consolidating and trying to figure out if we're going to break above. And then, a lot of us were like, oh my gosh, are we really going higher? And, we're right in the middle of COVID. It's a mess. And the stock market's forward-looking. Stock market's looking forward 6 to 9 months. It's trying to figure out. It doesn't really care about backward-looking stuff. It's looking forward, and it knew that money was being, handed out to people. We had stimulus coming, and grew everything, pushed everything up. There's this mid caps weekly chart. This goes back to 2017 through present, and just went straight up. Now it's been consolidating for a long time. It's still over this line. It's still kind of over this channel as of today. So it's constructive. Here's the small caps. Small caps are at the bottom of its channel, just blasted higher, and then it's been consolidating for almost a year. Now, under the surface, that's where you can make money. You can't make money in the index. You make money in the stocks. So if the IWM is up here, this represents the Russell 2000 index. And then you have several other small cap indexes, like the S&P 600. There's 600 stocks. As long as this thing is up here, it's telling you that under the surface, you're going to have lots of stocks you can choose from for the small caps. All right, this is probably one of the more ugly, scary charts, S&P 500 index. This is a monthly chart. The index's monthly chart goes back to 1998, and I wanted to look at the slope of the 1998, 1999 before the dot-com explosion. Look at this slope versus this. Now, percentage-wise, they're about the same. Usually when you have a crazy uptrend, you're going to be around 25 to 30% for the year, plus. And that's what we had. We had a plus 27%. And that's huge. That is just, that's an outlier. Doesn't happen that often. And we got overstimulated. Now stimulus is over. So 4.45 trillion is done. The Fed is now a headwind and no longer a tailwind. They're raising rates 3 times, maybe even 4. And they're stopping their bond buying, which is quantitative easing. And they're going to actually start cutting back on their balance sheet. They own $9 trillion in bonds, and they're going to start cutting that. So now it's, instead of called quantitative easing, it's called quantitative tightening. So when I see a chart like this, these usually end badly. But we do have real earnings. We do. We have $220 worth of earnings. We'll probably be at $235 worth of earnings soon in the next month or 2 or 3. The analysts are always looking forward for the year. And they'll say, all right, well, we're probably growing 7, 8, 9% in earnings. So we'll be at $235 worth of earnings. So we have real earnings. We do. And so then if you want to figure out, all right, well, where should the S&P 500 really be then? You can just take a quick little calculator here. So we have, let's say, $230 worth of earnings times 19.5 times 19.5 times earnings. I'm sorry, times 19.5 times multiple. 19.5 times $230 worth of earnings, let's say. Should be about 4,500. So the SPX should be around 4,480, 4,500-ish. And so it's not going to really probably pull back that far. Maybe we come down to here. So it's just crazy growth, crazy growth. Look at the Qs. The Qs, that's the NASDAQ 100, 100 of the largest tech, non-financial stocks. Problem is we have these mega caps now. We got Apple, Microsoft, Google, Amazon, and they're huge companies now. They're 2 trillion, 3 trillion in market cap. They move a lot of the indexes these days, and that is creating a problem, at least for people who trade these indexes. I mean, unless you want to go long on them, and you can, like the E-minis. I believe one of you trades E-minis, and sure, you can ride these uptrends. So crazy uptrend. Now, is that sustainable? It doesn't look sustainable to me. That looks parabolic to me. All right, volatility has been an ugly year, just all over the place. This is VIX. That's volatility, forward 30-day volatility for the S&P 500 index. It has been bouncing between 15.5 up to 40. And it's been tough. So if you're doing an options trading strategy that's more sensitive to movement, this is a nightmare. It's a nightmare trying to do this through a pandemic. It's just really tough. Market breadth. Market breadth. If this is actually a pretty good leading indicator. So market breadth is number of stocks that are advancing versus declining. This is the advanced decline line. So advanced decline line means on a daily basis, how many stocks advanced in that index, this is for the S&P 500, minus the number of stocks that declined for that day, and you get a number. And you take that number and you just keep on adding it every single day. So you get a cumulative advanced decline line. So now this is a couple days old. Not sure what it looked like today, probably pulled back a little bit today. But we're getting mixed signals now, so this one looks okay. We have 2 moving averages on it, so this 17's over the 40, and we took out a higher high. So that's pretty impressive. But look for the NASDAQ composite. It's actually getting pretty hammered. So this one has like 2,500 stocks in it, and a lot of these stocks got overvalued. So when you see an advanced decline line looking like this, in general, you're going to see price pressure. We're going lower, at least for that index, or for a lot of the high-flying stocks in that index. Worldwide charts. Here's Europe, Germany, emerging markets, EEM. Here's China. Here's kind of the world, less the United States. I'm seeing a lot of kind of downward sloping. Here's Germany, emerging markets. Now this is, I told clients a year ago, don't touch emerging markets because our interest rates are going to start climbing, the dollar is going to start climbing. That will push down the emerging markets because they're very much commodity based. And it's continued. It's been in a downtrend for all year. China, that's a lot of regulatory risk. They're cracking down on companies, and they're almost uninvestable right now. You have to just wait on China for much longer, a lot longer. Europe is looking good. This is IEV, 300 large companies in Europe across European Union. So it looks like, to me, this is a little weird that Germany's down, but all of Europe is looking decent. I have a feeling we're going to get a breakout here. And I'll probably add this to our tactical global ETF strategy. I'm going to wait. You have to wait. Be very patient. So, and then this is, world, everything just got overbought. Everything got overbought. Could I look at 200-300 charts a day or more? And boy, I've never seen so many overextended and overbought stocks. Just, it's just crazy. I've never seen it like that other than 1999. So I don't like what I see, but at least earnings are going to grow by 8%. I just think stocks are probably not going to grow much more than 8% also. If we can get 8% out of the stock market, I think we're doing well. Meaning you got a stock pick now. You don't want to be in anything that's broad. No broad indexes. Well, we'll get back to that list because I'll kind of, after we're done with all these charts, and I'll give you my thoughts on answering those questions. All right, some of the sectors. Here's financials, XLF, industrials, XLI, banks, KBE, equal weight consumer discretionary, RCD. Financials looking good. Industrials look okay, not bad. You just have to be careful on these because interest rates are climbing, and some of these are interest rate sensitive. But financials are definitely going higher. Banks are going higher. Consumer discretionary, similar. Because if the Fed starts slowing things down with 4 rate hikes, they could slow things down. They can slow this market down. The economy down. Here's utilities. Usually a safe haven, but when interest rates are pushed up, then it makes, because these guys borrow a lot of money, for their plant and equipment. But looks okay. Real estate, the ETFs, these REITs, the real estate investment trusts, have just gone crazy all year. I mean, just much higher gains than I thought they would ever make. So I've had a few here and there, and I've made money on them, but man, they just went straight up. Just don't know how long it's going to last. If this thing can't keep on going higher, if it just keeps on hitting resistance and just kind of getting stuck here, it just tells you that with interest rates going up now, real estate investment trusts might not be the place to be now. Here's energy. Energy's taken off. So with regards to energy, what's going on is that as we gradually move away from fossil fuels to electrification over the next 20 years, we're going to end up with less supply of oil because people are drilling less. They can't get funding to drill, add more rigs. So we're going to have less and less supply. And I think it's just going to keep oil prices up. So I saw a few analysts thinking that oil prices for a barrel of oil are going to stay above $80 a barrel for a long time, if not forever, just due to how we're cutting back on fossil fuels now. So, oil could be at 80 to 100 bucks a barrel for a long time. IYT transports, rail, truck, air. I mean, this one's kind of hitting resistance again. Higher interest rates don't help these guys. But when you look at the rails, they're still growing earnings. Like CSX, large railroad. I just closed that one in the large cap because it wasn't moving enough. I got maybe a 2 or 3% gain, but I'm like, I just don't like interest rates. These are huge companies. They borrow a lot of money. Okay, the weekly advisory, that's at upsideoptions.net/weekly market update. Just go to the website. And the weekly advisory just looks like, see if I can find one. Don't see it. One second. Well, I'll come back to it.
Hey, Brad.
Yes.
Just a very silly question, if you may. What is that overbought stocks you refer to?
Overbought, overbought, overextended. It kind of looks like that. You'll see stocks that just, I mean, this is a monthly chart, but you'll see a daily chart of, like a Shopify or, back with Zoom or Peloton were running hard. Basically they just started going parabolic. And so usually we'll call them overbought or overextended stocks. They start getting really expensive. They start trading at a high price earnings ratio. And so when you see something going parabolic like this, we'll just say it's overbought, and then usually you want to start being really careful. And you don't want to give it, try not to give your gains back. Try not to give your gains back. Try to hold on to at least half of your gains. And so what you want to do is set levels, set levels, and these are lines in the sand. Say, all right, I'll sell it in 3 parts, a third, third, and third. If it breaks below this level, I'll sell a half. Breaks below this level, I'll sell another, or a third. I'll sell another third. Because you can't predict the future. You just don't know what's going to happen. All you know is that your stock was a 4-bagger. You had a 400% gain. Now you only have a 300% gain. So what are you going to do? Ride it all the way back down? Well, you can, but then why even be in the market? It's like because the market is its job is to rip your face off. And right now the market's been very easy for the last 18 months. So everyone feels smart. Everyone feels like, oh, this is easy. Well, actually, the stock market is not easy.
Evil.
And yeah. So it will be it will get ugly one of these days. So for the advisory, it comes out every week. And a lot of these charts I'm showing you are in the advisory. There's 50 charts in the advisory. So I look at it every week, Sunday night, get it out. And it helps pretty much all types of styles and strategies. Okay,
Hey,
sentiment.
Brad,
Yes.
Brad, one more question. Do you have any specific observation for the IT sector?
IT sector. I'd have to bring up the ETF of that one. And yeah,
no,
there's
just wondering if you have got any specific observation.
Here, I'll take the action item. I'll send you that IT sector, and I'll give you my thoughts on it. There's I'll show you a chart here in a minute. What, right here, for example. Okay, so here's market sectors, and I have it in here. I got, but this only shows the top 25 sectors and then the bottom 25 sectors. I got a total of 100 ETFs, 100 sectors that we follow. And I don't know where it's landing. All I can tell you is like some of the tech stuff, like robotics is in the bottom. Cybersecurity is in the bottom. Artificial intelligence, robotics is in the bottom. Here's internet, absolute bottom. So these are relative strength of these sectors. So I'll get back to you on the IT. I forget what the actual ETF is on that one, but I follow it, and I have maybe about 150 total ETFs that I follow in this one tool that kind of gives me a mapping of relative strength, and I'm not exactly sure where it's sitting at right now. Okay, sector. So financials are looking good. Banks are looking good because interest rates are climbing. Industrials, you just have to be choosy. Real estate, be careful with real estate. It's run really hard for the last year. So if you see a REIT that's still climbing, maybe keep on climbing. But usually REITs don't like higher interest rates. Transports, they got to borrow a lot of money. I'm not sure. So I got out of CSX, and there's a couple. Trucking companies are still doing okay, but they tend to be pretty choppy. Railroads, I don't know. I got out of mine. All right, sentiment. Kind of, are people still willing to get into stocks that have come a long way or are getting more expensive? Microsoft's trading at 33 times earnings, so it's not super expensive. Apple's around there also. I think Google's trading at 60 times earnings. Amazon is, they're all kind of fully priced with regards to their price earnings ratio. So they're not cheap. They're not cheap. Now, Google is just off the charts. I mean, they grew earnings by 100% last year. Unbelievable. For a large company like that to grow earnings by 100%, they're growing like a startup. Just wow. Just absolutely crazy. And Microsoft, I mean, they're growing earnings by 15% now for the next 2 years. So 15% growth, should that really justify this type of chart, in trading kind of I think it's 40 times earnings? Probably not. I think Microsoft's coming down. Apple now, they're not growing much. They're only growing by 2% in 2022. I don't like that at all. And now the stock's not super expensive. It's trading at 31, 32 times earnings. It's just, these are big companies. They're big companies. And so sentiment just tells me, yeah, people are still willing to pile in. Nothing wrong with that. All right, and then DocuSign, these are all of the high flyers. They all kind of are starting to roll over big time, and even round tripping. Here's Teladoc, full round trip up, turned into a 3-bagger, 300% gain down to 0. So if you know what you're doing, you probably could have kept 200% of that gain. But you got to be nimble. You have to be nimble on this stuff. Square, rolling full over, Peloton, full round trip. Probably had a 4 or 5-bagger on that one, down to 0. So what that tells me, at least sentiment-wise, at least with regards to the stay-at-home plays, the COVID stay-at-home plays, that's long gone. And for like what we look at when things start getting toppy and choppy, if we owned one of these, actually we own some of these, and we try to book our gain before we lose it, and it'll start getting toppy and choppy. And
do you have Zoom also?
Did I show Zoom? Oh, I'm sorry. I thought I had it. I don't know what happened to it. I had it. I don't know what happened to it when I was cleaning up these slides.
Never mind, but it will be similar to that.
Yeah. Let me just look at it. Zoom looks just like Peloton. Not quite as bad. It's kind of like down to here. Looks just like this, but it's stopping right here right now. So it hasn't taken out this last piece. Okay, economic data. Huge inflation. PCE core inflation off the charts. We've never seen anything like this other than the 70s. CPI, inflation off the charts. I was listening to one analyst last night, and she's just like, yeah, she's like, I think the Fed might have to really push us into a recession in 2023 to get out of this. So we don't see that in 2022. Market's going to get more choppy. If we can get an 8%, 10% gain, 7% gain out of the market just for the broad indices, that's probably pretty good. I don't see any recession, don't see any huge crashes, but I see that the Fed is going to be scrambling, raising rates. So here's the TNX. This is the 10-year rate, interest rate at 1.7 and change. And it's been in a long-term confirmed uptrend, for a year and a half. And then it finally broke up through. So this thing wants to go higher. So when interest rates go higher and the Fed wants to raise rates, as we always say, don't fight the Fed, don't fight the Fed. Meaning, don't be buying broad indexes, broad ETFs, anything that you just want to like buy and hold. You want to stock pick. And then if you don't have time to stock pick, then you outsource to someone like us where we can do it, because it takes about 4 to 5 hours a day. It's a full-time job, about 30 hours a week to be a good portfolio manager for active management and constantly be rotating in and out of positions. I'll talk more about our methodology. Retail sales are pretty good. I mean, the economy's okay. I mean, non-farm payrolls, we added 199,000 jobs, adding about 400,000 jobs every quarter on average. So we're kind of getting through it. Unemployment rate's down low. A lot of people are not quitting or not getting fired anymore. This is the quit rate or the fire rate here. Initial unemployment claims. If they get fired, they turn on their unemployment claims. And manufacturing it's not a huge part of our economy anymore. It's 15% of our economy, but manufacturing is strong. It's above 50, it has to be above 50. And if it's above 50, it says manufacturing is expanding in the United States. This number comes out every single month. That's called the ISM index. So manufacturing is expanding. Capacity utilization, as long as this thing is climbing, we're okay. And here's the definition of it, because it's a little funky. Capacity utilization it's the relationship between output that is produced with the installed equipment and the potential output which could be produced with it if capacity was fully used. So really, how much we're able to produce versus how much we're really producing. So for example, back when COVID hit, we're only using 65% of our capacity because all the machines were turned off, all the people were fired, all the places closed down. But things were still running. We're still using 65% capacity. And then now we're up to about 77, 78% capacity. And once it gets a little too high, if it gets up here in the 78, 79, then inflation starts becoming a big problem, but we already have inflation. but we're using about 70, almost 77% of our capacity now to create stuff. So that looks good. This is positive, non-defense capital goods orders. This is basically a proxy for business spending. Businesses buy equipment, they buy services to make their businesses better and to be able to handle higher demand. So in general, the businesses are spending money and they're growing at about, they're spending about 10%. And that's good because businesses spend a lot of money. Housing starts, it's all climbing. This is about 7% of our economy is all the money and salaries and everything around housing and other buildings, building commercial buildings plus residential structures. So that's good, that's climbing. Overall, the economic data looks good other than, horrible inflation. Just, it's a mess. And the Fed is going to have to work hard to get that under control.
Hey, Brad,
Yes.
can I ask a question? I think I saw it, a yield curve
Yes.
starting to flatten a bit. I think I saw it on stockcharts.com.
Yes.
I think, I agree with you on almost all the indicators are showing we shouldn't have any kind of recession this year. The only concern I had was that
Flattening of the yield curve.
was starting to flatten a bit. I don't know if it's going to get worse. Hopefully not. But did you have any comment on that?
Yeah, you're right. I mean, so he's talking about kind of, you're looking at the rates on the 3-month, the 2-year, the 5-year, the 10-year, the 30-year, treasuries, and you basically want a upward sloping yield curve. So as you add duration of the bond up to like 30 years or 10 years, that's supposed to give you more return. And if that yield curve is flat or starts inverting, usually if that happens, then it kind of usually happens like a year in advance or 9 months in advance, and it tells you we could be going into a recession. So yeah, it's not perfect. It's not perfect because the Fed is pushing up interest rates. So that's the front end of the yield curve. So the 3-month and all the short-term stuff is getting pushed up. And then the far outside, the 30-year or the 10-year is not really moving that much. And what it does is it moves higher if people think that the economy is going to grow. And if the economy is not going to grow, then that the 30-year treasury might not go up too much for the yield. So it is something that has to be watched. I mean, it's pretty slow moving. It is a leading indicator, but many times it could invert and you still don't get a recession. But yeah, it is something that needs to be looked at and monitored. Market sectors. So what we're seeing, so everything, as long as the stock market under the surface keeps on rotating from sector to sector to sector, then we're okay. The stock market is okay. It's called under the surface. You have to look under the surface, not just look at the indexes. The indexes, 25 and 30, 40% of the indexes are moved by 5 companies these days. So you can't really only rely on the indexes. Of course, that's the first thing you look at, but you're looking at, the S&P 500, 25% of that movement now is just 4 companies, Microsoft, Google, and Amazon, and Facebook. And now Tesla. Tesla's pretty big these days.
I have another question on the rotation you're talking about.
Yes.
So with interest rates starting to creep up now, it's affected the high growth stocks like Tesla and Apple and Google's, all those, Microsoft.
Correct.
And as you say, the market's holding up okay because it's, there's rotation going on. But at one point, what do you think the interest rates would have to get up to where it would have a meaningful impact in terms of a market correction?
I've heard some analysts and economists kind of taking a crack at that. And it seems like they're talking about 2%, 2.5%. Right now we're sitting at 1.7, 1.8. We'll probably be up to, sometime in the next 6 months or shorter.
Okay.
But I mean, many times the stock market will still keep on climbing for that first year of tightening. So, many times investors will shrug it off. They will shrug it off for that first 6 months, 9 months, first year when the Fed is tightening. The first, you'll have little hissy fits. When the Fed does its first raise, it'll probably be in March. We'll probably be down 5%. We'll have volatility, and then we'll probably be right back up to where we were. But
overall, it doesn't seem like the sentiment, the AAII type sentiment or intelligent investors, that sentiment doesn't seem to be overly bullish. Do you look at that?
Yeah, I do look at it periodically, and I haven't looked at it recently. And sure, I think that a lot of people do realize that this market has come a long way.
But I mean, that would maybe give it fuel to go more or continue without crashing. If there's not a
Yeah,
lot.
it could. Sure. Well, you're right. Yeah, you're right. I mean, if you're looking for like, are we at a top? Usually everyone's bullish.
Right.
Everyone and their grandma plus the shoe shiner plus the taxi driver is bullish. And then when you start seeing that, that's usually an extreme. And so we're not seeing that. So as you're saying, could that be fuel for more upside? Well, sure, it could be. I mean, we're not done going higher. I mean, the SPX and some of these indexes are probably going to go a little higher. They could, but we have been expensive. We've been trading at 21.5 times earnings, and that's not the norm. I mean, something a little more normal is 20 times earnings, 19.5 times earnings. So we're still about 10% too high, 8% too high, and I think we're going to revert to that mean.
But I think also the interest rates are so low.
Correct. That is correct.
So, I mean, that's an adjustment to that PE, I think. Because there's no other place for money to go.
I know. You're right. I mean, could we stay at 20, 21 times earnings for a long time? Yes, I've been telling my clients for 2 years, a year and a half, 2 years, that we're probably going to stay expensive for an extended period of time.
But the interest rate thing, the inflation interest rate thing, that's could be the kicker.
Yeah.
If that thing spikes up more than we can control, then
Absolutely.
that would be the.
Yes. Well, I mean, don't fight the Fed.
Yeah.
Anyone that kind of fought the Fed in the last 18 months, they were not fully bullish, and whatever strategy they were using, they did not do well.
Right.
You fought the Fed. All right, so let's answer these questions. So how do the major index charts and sector ETFs look? What are they telling us? Everything's fine right now. I mean, there's rotation under the surface. So right now, banks, financials, regional banks, some industrials, some materials, even some of the metals. I mean, every week it's different. Every week there's money flowing into stuff, and it's flowing out of stuff. Overall, for the biggest picture indexes, they look fine. Some of them did go parabolic, but sure, we can stay expensive for a long time. So Apple, Microsoft, Google, they're expensive, but they're not horribly expensive. And then these have already rolled over. The Peloton, the DocuSign, the Teledocs, the Zoom, most of them have round tripped already. So what are the breadth indicators telling us? We're starting to get mixed signals. We're getting mixed signals. The NASDAQ composites advanced decline line is getting pretty ugly, and the S&P 500 index is still looking pretty good. So when we start seeing mixed signals, that's usually an indicator that we're starting to change trend. What the economic indicators telling us? Well, everything looks decent, but horrible inflation. And the Fed's going to have a heck of a time getting that under control. Corporate earnings, what they projected for 2022, about 8% growth, and that's good. So no recession, no huge market crashes, no bear markets or anything like that, at least for the first half, maybe through September. But you have to remember, the market's forward looking. It's looking forward 6 to 9 months. So by June, July, August, and sometimes summer is a little funky anyway with the market. It gets pretty choppy. And then sometimes on lower volume, and then we hit September, October. Everyone's looking forward now to, the next earnings season and the following year. And by then, I'm sure the Fed has already raised rates 3 times. How expensive is this market? It's been expensive. and it's probably going to maybe remain expensive for a while. But I'm never going to say ever, it's different this time. I don't say that. And it's different this time. No way. It's never different. Now it could be different for like an extended period of time, but earnings still matter and valuations still matter. And we've been expensive. So how will the market trade now that the Fed is tapering, quantitative easing, planning to raise rates? Where will it find support? I don't think we're coming down that far. SPX, as I mentioned, take $230 worth of earnings, multiply it by 20, and that's 4,600, 4,500-ish. Maybe we overshoot down a little bit, but those are just 5% pullbacks. We've had 5 of those already over the last 15 months. Every time we turn around, we got a 4 or 5% pullback, and then we bounce. But are we really bouncing to new highs this time? Probably not. Probably not. Do we see a recession in 2022? No. Should I sell some of my passive ETFs and funds that hold hundreds of positions? I don't like them. I've been telling clients for 4 months, get out of anything that's passive. If you don't have time to more actively manage it, where you don't have your exit rules set, make sure you have exit rules set and you know when to get out. And so if you own, I own the Qs, I own the SPY, I own the small caps, the IWM. If someone tells me that, I'd say, all right, what are your exits? And if they don't have exits, I'd say, get out, go to cash. And by the way, you can't even buy gold. Gold, actually gold maybe popped just in the last 2 days, but gold's been dead, silver's been dead. You can't be in bonds. So I just tell people, go to cash. Or if you want something really speculative, go to do a little bit of crypto. But it's very speculative. So I add short exposure hedges to my portfolio. So we're going to start buying puts and kind of managing those. And so every time we have a 5-6% pullback, our put positions will make 50%, 70%, sometimes 100%. And we'll have up to 3 positions. So it just kind of juices our returns and kind of helps out on the drawdown. Should I buy bond funds? No. If they're really, really short duration, 3-month or less duration, then you can get 2%, 1.5 to maybe 3 if you're lucky. And so they're out there, but it's just short duration bond funds because interest rates are climbing. So when interest rates climb, the actual bond fund itself goes down because they move in inverse. What's better right now, value or growth? Definitely value. Smalls, mids, large. Large are always good. You can always find stuff that's large cap. Mid caps look pretty good. Yeah, I think all of them can work because I see enough rotation under the surface that I can be in smalls, mids, and larges. Emerging markets, no. EEM, stay away from that. Europe might be waking up. Like IEV I showed, that one could be waking up. Just make sure you get a validated breakout before you touch it. Asia, actually, Asia is not coming up on my screens recently. I think China's maybe just pulling them all down now, but Vietnam looks good. It's not validated yet, so I'm not in yet, but sector ETFs and stocks best to rotate into now: industrials, healthcare, financials, energy, staples, technology. Some industrials, healthcare, it's hit or miss. Some of them have been rolling over hard, but some have taken off. So you have to be it's a full-time job. You have to kind of find the right subsector of the sector. Financials, right now, those are all easy. I mean, you can literally buy any bank or any regional bank, and they've been breaking out. Energy, same thing. They all look good. But one of these days, all of a sudden oil is going to go from 75 a barrel or wherever we're sitting at. And before you know it, for some stupid whatever reason, Saudi Arabia says something, or Russia says something, or Venezuela says something. And all of a sudden, boom, oil sells off, and then all your stocks are in losing positions. So you got to watch the stuff daily and know when to get out. Staples, technology. Again, I can find stocks just about all of these areas that'll still work, but with rising interest rates, it's going to be a little tougher. Like usual, it's like everyone always mentions, oh, Tesla, Apple, Microsoft. Okay, that's 3 stocks out of 4,000. There's 4,000 stocks that are, on, we have 1,000 in our watch list, 150 are in the portfolios. I look at Apple or Tesla or Microsoft like any other of those 4,000 stocks, or 3,500 really. So we can make money on any one of those. So I just don't want to just be piling into the same stuff like everyone else is piling into. What will the best investment style for the first half? Buying passive indexes? No, I don't like that. Stock picking? Yes, I do like that. Buying on the breakouts? I like that. Covered calls? Actually, that covered calls could work. Just buy some blue chips and just keep on writing calls against them. I have a feeling they're not going to move much. I bet you can bring in some decent covered call premium this year, because we just needed the market to slow down. We needed the Fed to finally change their direction, and they finally have. So things should slow down a little bit. Non-directional trading strategies. Well, I'm crossing my fingers that I could do it this year, because last year I couldn't. But when I say non-directional, like I sell calls and puts on the indexes, bringing in premium, and last year was just brutal. Just too much volatility, and the market just went in one direction. So non-directional does not work in a market that goes in one direction. Okay, so we have these final things here. What is the best methodology? I'll dig into that next. And then, how well can a selling option strategy work? Okay, any questions right now?
Brad, I'm gonna have to jump. My wife is summoning me for dinner.
Okay. I'll send you. I can email you the recorded version of this, so you can pick it up.
Okay, good. Please.
So just send an email to brad@qtrcapital.com.
Okay.
brad@qtrcapital.com, and I'll send you a link to the recorded. The overall presentation. It'll be available tomorrow.
Okay. Thank you. That was very very good.
Okay. Well, thank you.
All right. Thank you.
All right. Bye, John.
Yeah, bye.
Okay. And so next would be kind of looking at one of the strategies that we look at, one of the strategies that we run, for example, the small and mid cap strategy. This is a 2-page fact sheet, and I'm just going to kind of focus in on a few of these metrics here. So I'm just going to show you these, and I'll show you what the objective is, and then I'll show you why the methodology is what it is in order to achieve this. Okay. So these 2-page fact sheets are on the qtrcapital.com website. It has all the relevant metrics for the methodology. They're updated for Q4. And I just pulled them off of the small mid cap. So here's this first chart here. This is invest $1,000 in the small and mid cap strategy. And this is 4 years of track record. And you can see that the return is higher than the benchmark. The benchmark is the Russell 2000 index. So that's the first objective. Beat the market, beat the benchmark. All right, so here's the benchmark, 69%, and the Russell was 46%. So since inception, we beat it. Now you want to beat it with less risk. So here's the standard deviation. Annualized 15.4% versus 22.6% for the index. Meaning how much if you had a portfolio and you put this strategy in it, the small and mid cap, how much will it fluctuate? And how much will it draw down when the market gets ugly? And that is risk. And that is what this chart is. So this is on the fact sheet. Okay, here's the 2-page fact sheet. And here is that risk graph I'm going to show you. So let me zoom in on it. Right here, risk versus return. Y-axis is the return since inception for the fund, which is the small and mid cap, versus the benchmark, which is the Russell 2000. We have higher returns and lower standard deviation, lower risk. So that is the portfolio manager's objective, is to see if you can beat the market with lower risk. That is not easy to do. I don't know what percentage of the portfolio managers that can do this, but I don't think it's a big percentage. So we're able to beat the market with lower risk, meaning less fluctuation, less drawdown, less craziness when we have a really ugly market. And that's important. All right, so number of positions, 28 positions. It's more concentrated. And we're selecting high quality companies. So return on equity, ROE, is a metric of how high quality the company is. So we have almost 70% better on the return on equity of the stocks that we're selecting. Price earnings ratio is really how expensive that stock is, and our stocks are selected stocks are not that expensive compared to the average, 18.3 versus 28. Meaning we're not chasing stocks. We're not chasing expensive stocks. We're spending time and putting a lot of effort into finding new stocks with good technicals, good fundamentals that are inexpensive. Okay, I'll use the word inexpensive very loosely here, but they're not super expensive. Reasonably priced. Here's EPS growth. The stocks that we're selecting are growing earnings by 95% versus 10% on average for all of the stocks in the Russell 2000. So you can see that we're selecting really fast-growing companies that are reasonably priced. So, pretty good. And here's max drawdown. This is important here. Russell 2000 drew down 43%, and ours was about half of that. And that's very helpful. That you can sleep better at night when your portfolio is drawn down less. All right, so how do we do that? Okay, just a couple more on performance, and then we'll get into the methodology. So for small and mid cap, this was kind of the monthly. This is all on the QTR Capital website. Just shows finished off at 28% for the year. Last year was 16%. Large cap finished at 27%. Year before was 29%. Again, you can see this on the website, qtrcapital.com. Here's the contrarian. This one ended up at 40%. That's the one that we were getting into all the beat up companies after the crash, the COVID crash. Heck, just in 1 month, we made 21%. Got a little more choppy as things started bouncing around, but it still added up to about 40% return. So 100K account went up to 140. Now, can we duplicate that again? No, I don't think so. That was a opportunity one. That's what we initially called it. Opportunity. Market just crashed. Let's take advantage of this opportunity. How often do you have a 50% market crash, and because that's what the small caps did in 3 weeks from COVID. Okay, large cap, just invested. If you invest $1,000, this is over 3 years. Large cap is still beating it, but boy, this is hard to beat. When you have the index, the S&P 500 index going straight up, man, it is tough to beat it. But we're able to beat it. That's a lot of work. You have to keep on getting into the stuff that's working and getting out of the stuff that taking our profit and not losing our giving our profits back. You just have to keep on booking those gains and then getting into new stuff. Okay, so let's talk about the methodology. Methodology is basically it's a 4-step process. So you do macro analysis, and that's all the charts that we first looked at the highest level, big picture. What are the indexes doing? What are interest rates doing? What's the dollar doing? What's Asia doing? What's Europe doing? Kind of look around the world. What's all the different policies? And you're trying to modulate bullish and bearish exposure levels. And for the last 18 months, we've been bullish. Just market was going straight up. Everything was dovish. The Fed was not raising rates. We had $4.5 trillion of fiscal stimulus, so we just kept on staying bullish. Then we do step 2 is a technical scan. We're finding high probability setups, and I'll talk about that. Then we do a fundamental screen. We're looking for strong or weak companies, mostly strong companies if we're going long. If you want to go short on something, you find the weak companies. But fundamentals, how good the company is, accounting wise, revenue wise. Quantitative screen, this is all probabilistic stuff. And then we use technicals to trigger entries and exits. Okay, so just one thing to kind of wrap your brain around. An investment strategy comprises of style, methodology, and entry rules and exit rules. Okay, an investment strategy comprises style, methodology, and entry rules and exit rules. Style is kind of bigger picture. It's more like line up 100 portfolio managers that are experienced, preferably, people with a lot of gray hair, and they've been doing this a long time. And then one, portfolio manager might say, "Hey, I'm high conviction. I'm going to hold stuff until I get my gains, and even if it draws down, even if it starts rolling over and it's down 30%, 40%, 50%, that's fine. I'm holding it." Because I love the fundamentals of this company and I'm holding it for the long term. All right, that's a style. Another style, like what we do, hey, we like to actively manage. We don't trust anything. And if that thing starts rolling over, we're out because it's hard to know how low it's going to go. All right, that's our style. Because I've been burned too many times over the years. Been doing this too long, we've seen this movie before. So when something starts rolling over, you even know that it could be a great company and earnings could be growing, it could still get hammered. And it could all of a sudden, Wall Street could forget about it for 6 months, 9 months, a year, where the stock just went down and stayed down 25%. That will not help your portfolio. So our style is we don't play that game, but that's different styles. And you have to respect every person's style. Every portfolio manager is going to have a different style. All right, so style and then methodology. Our methodology is quantamental. So it's using technicals, fundamentals, and quant. And some people, which is really kind of part of their style, but because these kind of blend together a little bit, they might say, oh, I don't believe in quant at all. It's ridiculous. I don't believe in it. I don't use it. Or I don't believe in charts, technicals. We don't look at the charts. We just use fundamentals purely. If it's a good company, we'll buy. So that's kind of, again, a blend of style and methodology. Our methodology is much more regimented. It's like the technicals have to be perfect, the fundamentals need to be really strong, and the quant needs to be good. Basically, and these are just probabilities. So that's our style, that's our methodology, and then entry rules, exit rules. And then if you come across a portfolio manager that does not talk about entry rules and exit rules, just run the other way. I don't think they exist, but they could. I mean, anyone that's been in this business, especially a long time, they better have entry rules and exit rules. Before you even bought that stock, you better know when you're going to get out of it, or that ETF. Okay, so that's just kind of something to wrap your brain around. An investment strategy comprises style, methodology, and entry rules and exit rules. And once those are all pulled together, you got a strategy. So now you start building track record and see if it works. Okay, technical scan, what does that mean? So let's look at some breakouts. That's a typical pattern we like. We watch for breakouts. We got a scanning engine that kind of pulls these things up, and also they're easy to find. You're just looking for things that are breaking out. Here's Home Depot. Now, these are all old charts, but I'm still using them. Down here's the weekly chart. This candlestick represents 1 week of trade, and I show 2 moving averages, a 17 exponential moving average and a 43 exponential moving average. In general, when the 17 is above the 43, it's in a long-term confirmed uptrend. If the 17 is below the 43, it's in a long-term confirmed downtrend. Be careful. So that's why you want to be watching the weekly chart. The daily chart up here. So this is daily. This one goes back just a year and a half. See, this one goes back years. See, 2016, 17, 18, 19, 20. This is the weekly chart. Daily, I'm watching the 13 EMA, 50-day EMA, 200-day SMA, simple moving average, and 150-day simple moving average. And you want to be patient on these, and you want to get like some long consolidation. And then when you get a breakout and it's confirmed, then you're like, okay, I'll get in. And you could get in that stock and ride it. And then if it starts failing below that breakout, it's recommended to get out. So that's one technical pattern that you could trade. That's called breakouts. Here's another one, Marsh & McLennan. This is an insurance company. Here's the COVID crash, up, long consolidation. We started getting a breakout. So you could do that as an option. Here's Red Robin Gourmet. Now this one, here's the weekly. I always look at the weekly chart first, so you can kind of wrap your brain around, what it's doing. And this company has been pretty much been in a long-term confirmed downtrend for literally 7 years. I mean, we go back to 2015. Look at the 17s below the 43. Ugly, 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 ugly. You do not want to be going long this stock. Now you're getting in. You can actually make some money in here. Now we're long-term confirmed downtrend again for a year and a half. And then COVID crash. So I don't know. This company doesn't seem like they're doing that great. They're doing something wrong. It's time to fire the CEO or get another CEO in there and get new management in there and figure out how to fix this company. But what we're looking for now is we're looking for a breakout above this line. So see how this thing could possibly recover. So we have a scanning engine that finds these for us, and then you have to kind of dig into them to figure out if the company is starting to do better. These go into the contrarian. That's a contrarian pattern. because I want this thing to go from 35 back up to 70. I want 100% gain. However, this chart's not a great one because it tells you it's been kind of a lousy company for a long time. I like the ones that were really good companies all the way across, and then they crashed with COVID, meaning most likely within a year or two, it's going to be right back up to that high because they were executing well, that company. This one is not executing well. So you got to be careful with that company. Okay, Movado. Actually, not that much better. Movado
So
was, yes.
Brad, in this kind of companies, if we see that there is a management change or CEO has been fired and etc., so that would be the right opportunity to buy, right? I mean, or should we still not have confidence in that company?
Well, when you have a management change, and actually most of the fundamental packages will tell you that. They'll show you exactly where the management change happened, usually the CEO.
Mm-hmm.
And if you get a management change, that's good. That's a step in the right direction. You want the technicals to confirm, though.
Okay.
The technicals of the chart needs to confirm before you get in. So technicals are when you get in, those are your rules of getting in and getting out.
Right.
Fundamentals just tell you if it's a good company, if they have a new CEO and things like that. And so they're very different. And so the technicals will tell you when to get in and get out. So here, like from Movado, it's starting to break up through this level here. And then actually, I did ride this one. This one's old, and it was a nice winner. I think it went up to 49. So I'll sell right here. When that thing hits 49, usually happens in the first hour of the morning, I'm out. We'll take our profit. If it gets over 49 bucks, then it's a new trade. Then you get in again. Okay, PKI. Now this is called an Elliott wave 4-buy, meaning kind of climbs, kind of has like a wave in it. It's not a great one, you can't really tell, but, and then it pulls back to the 200-day line. It's finding support on the 200-day line, and then it starts, the probabilities are increasing that it will go higher if it stays on this 200-day line and continues to consolidate on its 200-day line. And before you know it, it'll be right back up to 160 bucks. So the trade on this one is you basically want to make money between 140 and 160 bucks. So basically $20, you might get a 17% return on this one, or something like that. Okay, so back to the scanner. Top level stuff, those were all kind of the first charts we looked at. And that's modulating bullish and bearish exposure levels, and then a technical scans to find high probability setups. And I showed you some breakouts. I showed you some stocks that were recovering from being really low. Then you do a fundamental scan, and you're looking for mostly strong companies. We're not really doing any bearish trades on these stocks, so just we're looking for strong companies. So here is, I use MarketSmith. This is MarketSmith. And this is a recent one for Apple. Here are the years here. Here are the earnings here. And earnings for 2021 was $5.61. Earnings for 2022 are projected, estimated to be $5.75, or a 2% growth. It's trading at 31 times PE ratio, which is about correct. Its 5-year range of the PE ratio is 12 to 42. So it's really not even up towards its top price earnings ratio. So that's good. So that's where so this is a typical fundamental analysis, and you're just kind of looking, are they growing earnings? So you want to keep it simple, and then all these are like proprietary ratings. We just kind of look through all of these and figure out, is this company good? Is it a good company? So that's the fundamental screen. Quantitative screen looks like this. So this is quant, the use of econometric statistical math, provides predictions such as probability that a stock will break up or down through a particular level, probability that a stock will move a particular magnitude up or down once it breaks through a level. This requires several years of education in statistics, econometric math, along with 2 or more years of experience in developing and optimizing models. You're trying to create models that have predictive significance. And that's not easy to do sometimes. You can create a model, but it's like garbage in, garbage out. So to create models that have predictive significance, they need to be optimized, and you're constantly, massaging them to have confidence in them. And the output looks like this. So you end up with about 3,500 stocks, and then you end up with all these probabilities. And you can generate one every month sometimes, it's probably fine, sometimes once every 3 weeks. And it's just another way of screening the stock. All right, and then technicals, that will trigger your entries and exits. So as you mentioned, hey, stock, company just got a new CEO. Well, that's more fundamental, that's fine. That's good, but what's the chart telling you? The chart will tell you when to get in and when to get out. The chart will tell you when to get in and when to get out. Those are called technicals. All right, so let me summarize the style and methodology summary. So our style is active management. Active management, but the negative is it takes a lot of work. It takes 4 hours a day, 5 hours a day to be a good active manager. And we focus on a concentrated portfolio of 25 to 28 holdings. So not many more than that. We'll still keep it somewhat diversified, but we're only in the stuff that's working. And so pretty quickly, like recently, we're in materials, we're in banks, we're in money center banks, regional banks, maybe some chemicals and some industrials and energy. And like today, the whole market was down and our portfolios were up. They were nice. I mean, barely up, maybe flat, but nothing stopped out. Nothing stopped out. So what that tells me is we're doing a good job of staying on top of the right stuff quickly enough, so we're not getting hit by a market that's rolling over. All right, so stay invested, but stay very nimble. Keep extracting gains out of the market, even when it's expensive. But the market needs to be in a long-term confirmed uptrend. Healthy rotation happening under the surface is part of that. You got to see healthy rotation. Market needs to be in a long-term confirmed uptrend. And if it is, there's a bunch of things you can look at. Actually, I showed you one thing. Weekly chart, 1743 EMA. So bring up the SPX. As long as that 17 is above the 43, you can say that we're probably in a long-term confirmed uptrend. But now you have to look at the other indexes too. So make sure you look at the NYSE composite, the NASDAQ composite, the Qs, IWM for the smalls, and mid for the mid caps. So you want to look at all of them. And then if you start seeing the weekly charts are starting to roll over and the 17's breaking below the 43 on a weekly chart, that's starting to warn you that this uptrend is over. Identify fast-growing companies with positive earnings and good fundamentals. Positive earnings is a key phrase here. I do not get into anything that has negative earnings. If it does not have positive earnings, I don't touch it. So most of these companies have been around for at least 2-3 years, and they're making positive earnings now. Now Tesla, it's making positive earnings now. It is in the last 2 years, and they're cranking. They're growing earnings by 50% annually. I think even a little higher. But it's also trading at 200 times earnings, and and the chart is just crazy. So there's plenty of stocks I can go after, and I don't have to go after a Tesla, and that's trading at 200 times earnings. Keep drawdowns to a minimum. Try to keep your losses down below 10%, 8%, preferably 7% if you can. Don't let anything draw down. So follow well-defined exit rules. Open hedges when appropriate. Okay, so that is kind of the style. We're active managers, concentrated. We stay invested most of the time, unless this market tells us we are no longer in a long-term confirmed uptrend. Right now we are, and we've been for a long time. 4-level quantamental analysis, this is the methodology. So we do technicals, fundamentals, factor-based quant. We follow strict entry rules. So in general, most of the time we're buying fresh breakouts. We're not chasing stocks that have already run. These fresh breakouts represent a high probability, lower risk technical entry point. I'll repeat, these entry rules will usually get us into a high probability, lower risk technical entry point. That's what I like. That's my style. I've seen this movie before. You go after something that's not a lower risk technical entry point, then you can really get burned if it fails. If these fail, and yeah, periodically we'll get into something, doesn't work, we're out. we lose 5%, we lose 7%, maybe we'll lose 9%, 10%, but at least we're out. And it wasn't horrible. It wasn't like a 20% loss. Follow well-defined exit rules, let the winners run as long as possible, but exit fast enough to lock in most of the gains and to protect the capital. You'll never time the top, you'll never time the bottom. So just try to hold on to most of the gains if you can. So for example, in October 2018, the market started crashing pretty hard. Our methodology, we went from 75% allocated in our portfolios to 30% allocated in 6 days. Now it's a lot of work, it's no fun because it takes all this effort to get into all these positions, and now we're getting kicked out of every single, most of our positions. So every day there was like 2, 3, 4 stocks were being, hitting the exits, being triggered, exit triggers. And we just follow the rules. You're like, okay, we're out, went down to 30% allocated. So here's how 2018 finished. Our portfolios were up 18 to 25%, and the benchmarks all closed at losses. Now that's kind of random, because we just happen to be at the end of the year, and December 31st happens to be the end of the year when you're looking at portfolio returns and metrics. But it is what it is. It happened to hit it at the very end of the year, and we're just following our rules, and we ended up with nice gains, and all the portfolios, all the benchmarks got killed. Okay, so I think we're gonna have to stop there because we went way over, and I'm not going to be able to do any options or anything, but that's that covered the mostly our equity strategies. Okay, any questions?
Good. Thank you very much. I have to drop.
Yep.
I'll talk to you later.
All right, I'll talk to you later.
Thank you very much.
All right.
Appreciate it.
All right. All right, Eugene, you're the last one. Any questions? Okay, maybe you left. Okay.
Brad, I'm here.
Oh, hey, Eugene. Yep.
How you doing, man?
I'll just do it really personalized, since again, we had 47 signed up and we only got a few that actually logged in. So, but I have the recording here, so I'm just going to forward the recording to all of the people that were not able to make it. But all right, so that just kind of covered our stock picking discretionary stock methodology. So yeah, so what are you doing on the stock side? Anything?
Yes, I do.
Here, let me just stop recording this 1 second. Chat.